Stop scrolling, stop ignoring the signs. Do you feel it? The world is shifting beneath your feet, faster than anyone expected. And the dollar, the backbone of global stability, is crumbling right now. You need to know this today, because it touches your wallet, your future, and the power dynamics of every nation on Earth. Prices are rising, markets are shaking, and governments are making moves that will affect every single person. Stay with me. Because in the next minutes, I'm breaking down the shocks, the strategies, and the consequences that they don't want you to fully understand. By the end of this video, you'll see clearly what's happening and exactly why the world is on the brink. And it all starts with this dollar weakening sparks. Dollar weakening sparks global sell-off signals as U.S. policy shift confirms forced devaluation strategy the moment the dollar started slipping. Global markets reacted with an almost instinctive jolt, because everyone knows a currency as entrenched as the U.S. dollar doesn't move without a cause. And this time, the cause wasn't speculation, rumor, or retail panic. It was Washington. A policy shift, subtle in language, seismic in consequence, sent a clear message to every investor, every central bank, every trading desk from Frankfurt to Singapore. The United States is preparing to weaken its currency on purpose. That's not an accident. That's not noise. That is a strategy. And the world is now adjusting in real time. You could feel the tension in the financial system the moment the news hit. Money flooded out of dollar-heavy positions like someone had yelled, "Fire in a crowded theater." Traders didn't wait for confirmation. They moved instantly. Why? Because markets don't react to official statements. They react to signals. And this signal was unmistakable. The U.S. is prioritizing debt relief over dollar strength. The math behind the decision is as straightforward as it is unsettling. A weaker dollar makes it cheaper. Much cheaper for the government to pay back its astronomical debt. And investors know exactly what that means. They're about to become collateral damage in America's survival strategy. This is where the global sell-off signals come in. When the world senses intentional devaluation, they don't wait to see how deep it goes. They exit hard, fast, quietly. And that's exactly what's happening. Behind the scenes, foreign institutions are reducing exposure to US assets, diversifying into other currencies, and most importantly, moving into hard stores of value that don't depend on Washington's choices. Gold, energy, strategic commodities, anything that doesn't have USD stamped on it. Because when the issuer of the world's reserve currency hints that it's about to water down the value of every dollar in circulation, global players don't want to be the last ones holding the bag. And let's be clear, this wasn't a mistake. It wasn't a slip-up. The policy shift revealed exactly what analysts have been whispering about for months. The U.S. cannot sustain a strong dollar while carrying the biggest debt burden in world history. The interest payments alone are becoming unsustainable, borderline unmanageable. Something had to give. And what gave is the very thing the world depends on: dollar stability. You weaken the dollar, you buy time. But you also send a message that the era of unquestioned dollar dominance is over. And once that message is out, you can't pull it back in. The sell-off didn't happen because traders are emotional. It happened because they're rational. They know a forced devaluation when they see one. And they know what comes next: inflationary pressure, rising import costs, and a global repricing of risk. If you're a foreign government holding us treasuries, you just took a hit. If you're an American consumer buying foreign goods, you're about to take a hit. If you're a business depending on international supply chains, you're definitely going to take a hit. This is what devaluation looks like. It's not always dramatic at first. It's quiet, creeping, then suddenly everywhere. What made the reaction even more intense is that other major economies immediately began adjusting. China didn't hesitate. Europe didn't hesitate. Gulf states didn't hesitate. They've been preparing for this moment, stockpiling gold, forming non-dollar trade alliances, building alternative financial rails, and now they're accelerating those plans. Because when the country issuing the reserve currency signals weakness, it's not just the dollar that gets marked down. It's American influence, American leverage, American guarantees. Everything tied to us financial power becomes just a little bit less certain. And that uncertainty is what creates a sell-off environment, not panic strategy. The kind of strategy that big players use when they know a shift is irreversible. Once a currency starts down a deliberate weakening path, history shows it rarely stops early. The incentives are too strong, the debt pressure too high, the political cost of reversing the decision too steep, and everyone watching from the outside understands this. They are repositioning because they know the U.S. needed this devaluation to happen. The most striking part of this entire moment is how exposed it leaves the American public. Everyday people were not warned. They weren't prepared. They weren't given a clear explanation of what a weaker dollar means for their daily lives. But global markets understood immediately. They adjusted, they protected themselves. Meanwhile, American households are about to feel the effects through rising prices, shrinking purchasing power, and a slow bleed that doesn't feel dramatic at first, but feels unavoidable with each passing month. Investors are reacting not just to the dollar's current decline, but to what it represents structurally. A shift in monetary policy, this significant tells the world that the U.S. government is prioritizing debt management over currency strength. And once that priority becomes visible, it changes global perception permanently. Credibility is the backbone of a reserve currency. When credibility cracks, everything built on it starts to wobble. Trade agreements become less rigid. Foreign reserves become less committed. Geopolitical alliances become less automatic. That's why the sell-off signals were immediate. Markets don't wait for the official story. They react to the underlying truth. The downward trajectory is now baked into expectations. That's why you're seeing a rotation towards safer, more stable stores of value. Institutions aren't waiting for a full-blown crisis. They're positioning ahead of one. And if the U.S. hoped the world wouldn't notice this shift, the reaction proves otherwise. Not only did the world notice, it responded with the kind of decisive, coordinated adjustment that only happens when global confidence breaks simultaneously. This is what the beginning of a devaluation cycle looks like. Subtle enough to ignore if you're not paying attention, but powerful enough to reshape the entire global economy. And now that the U.S. has confirmed the strategy, intentionally or not, the world is acting accordingly. The dollar weakening wasn't the event. The reaction was, and that reaction is the clearest sign yet that we are entering a new financial era where American dominance can no longer be taken for granted. Foreign central banks accelerate dollar diversification as gold and yuan surge as confidence in USD slips. Global financial systems are shifting faster than expected as central banks quietly but aggressively reduce their dollar exposure. What began as cautious hedging has now turned into a coordinated pivot, with foreign reserves being rebalanced toward gold, the yuan and regional currencies gaining strategic importance. The move isn't symbolic. It's a direct response to the growing belief that the U.S. is entering a deliberate devaluation cycle. Demand for physical gold has spiked, and yuan-settled trade has surged as nations seek stability outside Washington's monetary decisions. This is not speculative behavior, it's defensive positioning. Central banks are preparing for long-term dollar weakness. And the speed of this shift reveals a sharp decline in trust. Markets are watching this realignment closely, because once global reserve managers move, they rarely move back. Import costs set to rise as purchasing power falls as global trade partners move toward non-dollar settlements. Consumers and businesses are bracing for immediate pressure as a weakening dollar pushes import prices higher across essential sectors. Everything from electronics to raw materials is now more expensive to bring into the U.S., signaling a direct hit to household budgets and corporate margins. At the same time, major trade partners are accelerating a historic shift away from dollar-based transactions, forming new settlement systems that bypass us financial control. This dual impact, rising domestic costs and shrinking global dollar usage, marks a turning point. The dollar's influence is weakening, and the world is adjusting faster than Washington anticipated. The U.S. debt spiral pressures Washington into currency weakening as bond markets react. Higher yields, lower trust-mounting federal debt and record. Breaking interest obligations are forcing policymakers into a corner, triggering a strategic push toward a weaker dollar to reduce real repayment costs. But the bond market isn't buying the narrative. Yields have surged as investors demand greater compensation for rising risk, signaling a clear decline in confidence. This shift is reshaping global capital flows, with foreign buyers pulling back and domestic institutions absorbing the burden. The message from the market is unmistakable. Intentional devaluation comes with a credibility price Washington can no longer avoid. Emerging economies prepare for post-dollar trade era as investors brace for long-term dollar downtrend cycle. Nations across Asia, Africa, and Latin America are accelerating efforts to build trade systems that no longer rely on the U.S. dollar, forming currency blocks, bilateral agreements, and regional payment networks designed for resilience. This shift is no longer theoretical. It's operational. As these frameworks expand, global investors are repositioning for what appears to be a multi-year dollar downtrend. Capital is rotating into alternative currencies, commodities, and inflation-resistant assets as confidence erodes. The world isn't waiting for the dollar to fall. It's preparing for a future where it simply matters less. The dollar is falling, global trust is shaking, and the ripple effects are already hitting your life. But here's the thing. You can act, you can prepare, and you can stay ahead if you're paying attention. This isn't just news. It's a call to awareness, a call to strategy, and a call to take control of the information that shapes your future. The world is changing fast, and those who stay alert will navigate it smarter, safer, and stronger. This is USA World Reports, and we're here to give you the clarity you need to face what's coming. Thank you for standing alert with us. Hit like, subscribe, and share this video. Stay informed, stay ahead, and never let the world catch you off guard. The next report is coming, and it will change the way you see the global economy forever.